as the IMF and World Bank meetings come to an end, the IMF did release its regional economic outlook for Sub-Saharan Africa on Friday. Now, painting quite a grim picture, the fund says that it expects growth to slow sharply by more than 1 percentage point to 3.6% this year. Now, against the backdrop of rising food and energy prices and unprecedented levels of public debt and inflation, the fund is also warning that many countries will find themselves pushed closer to the edge with limited options going forward. Well, earlier I spoke with the IMF's Deputy Director for its Regional Economic Outlook report, Pattillo, and we talked about the immediate factors that could help cushion African nations from some of the recent turmoil.
We've outlined how the situation at this juncture is quite worrying for the global economy and for the region. So the region has been hit by shock after shock. From the pandemic now to the spillovers from the war in Ukraine, high food, fuel, fertilizer prices causing really a cost of living crisis. And this is compounded then by international conditions, very high global interest rates, slowing growth in the global economy, volatile commodity prices, climate shocks. And then this is in a face of countries with very high debt vulnerabilities and limited fiscal space. So what can be done? Countries need to take action themselves. Some of the priorities we highlight are addressing food insecurity, helping the most vulnerable then in this difficult time, addressing resolutely high inflation, adjusting monetary policy as needed, and consolidating public finances in the face of higher borrowing costs that are raising, interest to revenue ratios. And so countries need to take those steps to ensure their fiscal and overall macro is in shape.
Now, it is interesting because in the report, the new growth projection for Sub-Saharan Africa represents a relatively modest downgrade of about 0.2%. And that, of course, is compared with the April 2022 outlook. But, of course, you also say that revision masks some regional factors, which basically I take to mean that the outlook varies across countries. So give us some insight into which nations are better or worse off going forward.
We had around 33 of our 45 countries which marked down their growth numbers. The aggregate was only marked down by 0.2, affected particularly by the weight of South Africa, which has a large weight in our aggregate numbers. In terms of individual countries, some of the strongest performing countries, those with growth rates above 4 or 5%, include countries with strong macro fundamentals like Rwanda, Benin, a couple of tourism countries where tourism has recovered like Seychelles and Mauritius, and a few of the commodity exporters like DRC and Botswana.
Of course, we can't talk about the economic outlook without touching on climate change. And actually, the report points to the importance of setting the stage for sustainable growth and also greener growth. But you also agree that we must take the region's constraints and interests into account. So how significant will a sustainable and greener path be to a recovery in the region? And are we going to see the IMF expanding its lending facilities to better address climate issues in Africa?
Yeah. So the region is a region that has contributed little to global emissions, but is one of the most vulnerable to climate change. And you're seeing now the impacts of a lot of climate-related natural disasters and higher levels of floods and drought in the Horn of Africa right now. We have one of the worst droughts. The World Food Program calls it the worst drought, worst humanitarian issue this year. So going forward, countries need then to work toward climate resilient investment, green investment in infrastructure, in agriculture think about weather-resistant seeds, irrigation, transport, and storage facilities, and they need to invest for the green transition.
As we know, the reality is that many sub-Saharan African nations will struggle to meet their basic needs without significant additional financial assistance. So are we going to see the IMF helping to catalyze new capital inflows assistance? Has there been much progress in terms of securing additional pledges from the international community?
With so many priorities in the globe, the war in Ukraine, etc., there is concern that assistance could be continue to be squeezed. We are looking then also with the Resilience and Sustainability Trust that I mentioned to be able to support countries for developing climate resilience, climate change plans for the energy transition, and wanting that support also to help catalyze additional flows from both official sectors, from multilateral development banks, as well as from the private sector.